Amid escalating trade tensions between Beijing and Washington, China has strategically appointed a new international trade representative, a move widely interpreted as a signal that the Chinese leadership is bracing for a prolonged period of strained economic relations with the United States. Meanwhile, the U.S. president is hosting the Italian prime minister to address tariff-related issues. Expressing optimism, the president hinted at potential progress in negotiations with both Europe and China, while emphasizing that there is no rush to reach an agreement. Against this backdrop of diplomatic maneuvering, the trade war between the world's two largest economies continues to fuel instability in the energy market. Aggressive tariffs imposed by the U.S. administration are met with retaliatory measures from Beijing, creating a situation of mutual economic harm. The recent U.S. decision to impose 245% tariffs on Chinese imports has further intensified tensions, leading to a steep increase in the cost of goods coming from China. Amid the escalating trade standoff between the world's two largest economies, a notable shift is occurring, particularly in the realm of oil and natural gas supplies. China, in its quest to diversify its energy sources and bolster economic resilience, is reducing its purchases of American crude oil and liquefied natural gas, LNG, reorienting towards Canadian suppliers. This move marks a significant shift in global energy markets, prompting a reassessment of logistical chains and strategies. But what are the reasons behind this abrupt turn? To understand this, one must delve into the background of the issue. Starting in 2022, China and the United States have steadily ratcheted up tensions in their trade relations. Initially, the conflict primarily affected the electronics industry, the technology sector, and agriculture, but over time it has expanded to include automotive manufacturing, machinery, chemicals, and finally, energy. The U.S. administration, led by Donald Trump, proclaimed the principle of America First and imposed large-scale tariffs on Chinese goods, marking the starting point for the escalation of the conflict. From now on, America's own interests will take priority. One of the key aspects of this principle is the trade in crude oil and liquefied natural gas. China, in turn, is demonstrating its determination to respond to pressure from Washington by imposing tariffs or formal restrictions on energy imports from the U.S. Some time ago, the rapid growth in production caused by the American shale revolution opened up attractive prospects for Beijing. Affordable American oil and LNG helped China cope with its huge energy deficit, especially in 2017 to 2018. Energy trade between the two countries was gaining momentum. China imported millions of barrels of crude oil from the U.S. and was negotiating major LNG deals. There was even talk of Chinese companies investing in American LNG production facilities. However, the deepening trade war fundamentally changed the situation. Recent data indicate that China has reduced its purchases of oil from the U.S. by 90%, reorienting towards supplies from Canada. A new intrigue is unfolding on the world energy stage. China, driven by a thirst for profitable deals and stability, is increasingly turning its gaze north to the Canadian oil vaults. According to the latest Bloomberg reports, China has reached record levels in crude oil imports from Canada. So what is it that is making Chinese oil giants and state-owned energy corporations prefer Canadian oil? The answer lies in the attractive price and reliable supply of heavy oil from the Western Canadian Sedimentary Basin. In an era of geopolitical instability, Canada is seen as an oasis of calm, a more predictable and secure partner than the unpredictable United States. The Canadian energy sector, in turn, is ready to respond to this challenge, increasing supplies to China in the medium term. Canadian producers, armed with advanced heavy oil extraction technologies, see the growing Chinese demand as an opportunity to gain a foothold in the Asian market. And they don't seem to be missing this opportunity. According to reports, Chinese importers have almost doubled their purchases of Canadian oil in just 3 months. These figures are not just statistics. They are a clear confirmation of how Canada is confidently taking market share slipping out of the hands of the U.S. But why is China so demonstratively turning away from its southern neighbor? The answer, as is often the case, lies on the surface, in the tensions of the trade war that have clouded relations between the world's two largest economies. In this complex game of energy interests and geopolitical ambitions, Canada seems to have found its gold mine, skillfully exploiting the situation to its advantage. In response to Washington's tariff hikes on Chinese goods, Beijing retaliated by imposing high tariffs on American oil and liquefied natural gas, LNG. In some instances, these tariffs reached 25 to 30%, and according to some reports, they are even higher on certain types of oil. Furthermore, there are reports that Chinese state-owned companies have been given an unspoken directive to avoid purchases from unfriendly countries, creating significant obstacles for American exporters. American oil, already facing transportation, logistical, and diplomatic challenges, now finds itself at a competitive disadvantage compared to supplies from Russia, Saudi Arabia, and Canada. The situation with LNG is similar. China's purchases of American LNG have practically ceased following Beijing's decision to suspend imports. In recent years, China actively used American LNG to cover peak demand during the cold winter months and to meet growing industrial needs. Now, these supplies are under threat. However, as experts note, the imposed duties and administrative hurdles on American products have disrupted established trade flows. According to the New York Times, several American LNG producers have been forced to either redirect ships intended for China to other countries or terminate contracts altogether. This development deals a significant blow to companies seeking to increase U.S. export capacity in the LNG sector. In turn, China is showing interest in purchasing LNG from Russia and Qatar, and is also attempting to improve relations with Australia in order to diversify its sources of supply. Major players in the energy market are closely monitoring the situation, as the balance between U.S. imports and exports, the share of Canadian oil in the market, the expansion of Russian exports to China, and the actions of OPEC Plus in the Middle East all directly affect the price dynamics of oil and natural gas. If prices rise, China will not benefit, but the U.S. will also be at a disadvantage. If prices fall, Russia will suffer, but American shell companies will also face the risk of bankruptcy. An intriguing scenario is unfolding in the intricate chess game of global trade, where the pursuit of victory could lead to universal losses. Trade wars, like an inexorable fire, are engulfing new horizons, plunging the global economy into uncertainty. In this complex game, energy resources become a key asset, and each move causes a wave of excitement in global markets. Analysts believe that China's decision to reduce energy imports from the U.S. is nothing more than a strategic retaliatory strike. The Trump administration, seeking to put pressure on Beijing, may have underestimated China's resolve. Now, China is demonstrating that it is ready to strike at one of the most vulnerable points of the American economy. The U.S., striving for energy dominance in a new era, faces a serious obstacle. Losing such a large consumer as China could significantly slow export expansion. According to data from the U.S. Energy Information Administration, EIA, in 2022, U.S. crude oil exports reached an impressive 3 million barrels per day, a significant portion of which was destined for China. Now, this established supply chain may be disrupted, which will have unpredictable consequences for both sides. A 90% reduction in oil exports will result in significant losses for American suppliers, amounting to hundreds of thousands of barrels per day. And although this may seem like a drop in the ocean in the global crude oil market, it is a direct blow to the profits and established sales schemes of American exporters. At the same time, China, maintaining close ties with Russia, is actively purchasing Russian oil at bargain prices resulting from the Ukrainian crisis and Western sanctions. Moscow, desperately seeking new markets, has found a key partner in China. Chinese refineries are happy to purchase Russian Urals and ESPO grades at a discount of $10 to $15 per barrel. If you add imports from Canada to this, it becomes obvious that there is less and less room for American oil in the Chinese market. China is consistently building a multi-vector supply system, strengthening ties with both Russia and Canada. This strategy allows China to reduce its dependence on the U.S. and strengthen its position in the ongoing trade war. American oil companies, facing the loss of the Chinese market, are trying to redirect exports to Europe and Latin America. However, they face fierce competition in these areas as well. Middle Eastern oil-producing countries, Russia, African states, and Canada have already firmly established themselves in the global energy resource arena. In these circumstances, American manufacturers are compelled to seek new avenues for collaboration while navigating competition from lower prices and elevated transportation costs. Oil-producing companies, particularly in Texas and Louisiana, are voicing serious concerns regarding the loss of the Chinese market, attributing this to the trade policies of the Trump administration. However, Trump has shown no willingness to compromise, asserting that China is exploiting America. While this stance may appear to be a tactical political maneuver, it is difficult to assess the long-term damage it will inflict on the energy sector. Oil trade with Canada also presents certain logistical challenges for China, as the capacity of ports and pipelines on Canada's west coast is currently limited. Furthermore, Canadian oil is classified as heavy crude, requiring adaptation for Chinese refineries. Nevertheless, Beijing is already in discussions with Canadian companies regarding medium-term supply guarantees, aiming to accelerate the implementation of infrastructure projects to facilitate oil exports to Asia. Canada is demonstrating a serious intent to strengthen its position in the energy market, actively developing infrastructure on the Pacific coast. The construction of new terminals, expansion of tank farms, and modernization of the pipeline system all indicate the country's aspiration to increase hydrocarbon exports. Despite the challenges facing the oil-producing industry in Western Canada, such as complex extraction conditions and expensive technologies, the region has an opportunity to make a qualitative leap. Securing long-term contracts with a major consumer like China could provide a powerful stimulus for the industry's development. The deepening of energy cooperation between China and Canada indicates a gradual overcoming of the diplomatic differences that have clouded relations between the two countries in the past. Restrictions imposed by Canada on Chinese technology companies, such as Huawei, and retaliatory measures from China have created tension. However, the growing contradictions between China and the United States on the international stage may have prompted Beijing to adopt a more pragmatic approach in its relations with Canada. A similar trend is observed in China's relations with a number of European countries. Beijing is signaling its willingness to expand cooperation, which can be seen as a response to U.S. actions on the world stage. Experts believe that the activation of Chinese diplomacy is dictated by a desire to find allies in the confrontation with the United States in all areas. In particular, this concerns the market for liquefied natural gas, LNG, where the U.S. position has significantly strengthened over the past 5 years thanks to the shale revolution, which has doubled LNG exports, primarily focused on the Asian region. China, as one of the largest consumers of LNG, became the world's leading importer in 2021, surpassing Japan. However, in the context of the trade war, tariffs imposed by China on American LNG, and in some cases a policy of refusing purchases altogether, have created serious problems for American companies. Faced with the need to implement increased production volumes, they have effectively lost their largest customer. In search of alternative markets, American producers have attempted to establish cooperation with European consumers, but not all proposals have been accepted due to political considerations and price competition. Recently, in connection with the Russian-Ukrainian crisis, the demand for LNG in Europe has increased, but the high cost of American gas may become an obstacle to expanding cooperation. Volatility in the supply of liquefied natural gas, LNG, is disrupting forecasts for stable growth in this market. Despite allied relations with the United States, Canada appears to be forging its own trade path. Canadian companies, weighing the prospects of cooperation with China, are wondering about Washington's reaction because ultimately, profit remains the main priority for business. The Canadian government is taking a neutral stance, emphasizing that this is a commercial decision for private oil companies and Chinese importers, not requiring diplomatic intervention. These events reveal a large-scale geopolitical confrontation between the U.S. and China. The struggle for influence is unfolding in a variety of areas, from technological innovations to the agricultural sector, from financial markets to the energy industry. Trade in energy resources is becoming a powerful tool in the hands of both sides. In response to American tariffs, China may limit imports of oil and gas from the United States. Such actions have already led to a sharp 90% reduction in American oil exports to China. Changes in global energy policy are leading to noticeable shifts. Liquefied natural gas, LNG, supplies to China from certain regions have practically ceased, and Beijing is increasing cooperation with Canada and Russia. These trends could significantly alter the map of global oil and gas flows. In the long term, it is possible to form a new energy corridor that is an alternative to the traditional route through the United States, which could strengthen Canada's position in the international arena, both diplomatically and economically. However, the future development of events remains uncertain. One possible scenario suggests that the U.S. and China will still be able to find common ground and return to constructive dialogue. In this case, tensions in trade relations will ease, and energy flows will stabilize. At the same time, there is an alternative scenario in which the current tensions persist for a long time. In this case, China will continue to reduce purchases of American oil and LNG, strengthening ties with Canada, purchasing Russian oil at reduced prices, and developing relations with other OPEC+ countries. As a result, the U.S. may lose a significant market share in the Far East region and may reorient its export policy to European and Latin American markets, which will lead to further changes in the global energy balance. It will not be easy for American energy companies to make up for the loss of such a large consumer as China. During the recovery of the global economy after the pandemic, all eyes are on the growth in energy demand, and China remains one of the largest importers, meeting a significant part of this demand. What will this painful process lead to? At the moment, there is no end in sight to this confrontation. Both sides are likely to maintain their positions. The U.S. shows no signs of lifting tariffs, which have been extended until 2025, and China declares its readiness to retaliate. This shift in the energy sector may last until 2026 or 2027. Years of trade war risk further fragmenting the global economy and disrupting global supply chains. In the end, all parties will suffer losses, but, as experts note, political calculations may ignore these costs. Some analysts believe that the U.S. may show leadership and change the situation during the re-election period. The political arena today resembles quicksand, where every step can lead to unpredictable consequences. In the United States, calls to end trade relations with China are growing louder, finding a response in China itself, where there is a growing desire to reduce dependence on the American market. Behind the scenes of this populist rhetoric, diplomatic efforts are gradually fading away, and familiar trade routes are undergoing radical changes. An example of this is China's decision to close its market to American oil, opening the door to a new partner, Canada. This situation is just a fragment of the large-scale picture of the destruction of global energy markets, but even it is striking. Statistics show unprecedented shifts. Oil imports from the U.S. to China have collapsed by 90%, and purchases of liquefied natural gas have practically ceased. In response to the actions of the United States, China is strengthening ties with Canada, increasing purchases of Canadian crude oil to record levels. Thus, an alternative supply network is being built, covering Russia and Canada. The United States, in turn, is trying to compensate for the loss of the Chinese market at the expense of other regions. However, in an atmosphere of growing trade war, exporters and investors are seriously concerned. The new balance of power reveals the true cost of the trade war in the energy sector, making us think about the long-term consequences of the decisions made. It is now impossible to predict for sure who will win and who will lose in the current situation. However, one thing is clear. The growing tension in relations between Washington and Beijing could radically change the global energy landscape. In the modern world, every aspect of trade has acquired a political coloring, and the energy sector is no exception to this rule.